Hello, in this video, we will try to understand how MPC, Monetary Policy Committee, controls inflation using repo rate. So first of all, we have to understand that what is repo rate. In Indian economy, you will study that the total inflation like conditions or other conditions can be controlled by two ways. One is fiscal policy that is done by government, and second is the policies done by monetary policy committee that is comprised of three members from government of India and three members from the RBI. So this monetary policy committee actually decides how it will going to control the inflation. So they have many tools. They have quantitative tools, they have qualitative tools. For example, you already must have studied as the basics of economy that RBI have a lot of tools like repo rate, SLR, CRR, cash reserve ratio, and other things. So in this video, particularly, we will understand what is this repo rate and how inflation is controlled using this. To understand this, what I have done is I have linked this repo rate concept with this case 1. What is this case 1? First, I will just give you a brief introduction for it. This is a demand pull inflation. You must have heard the word inflation. What is inflation? When sudden prices is high and it is difficult for normal beings to buy goods and services like things in general layman terms. So inflation is generally caused by two factors. That is, one of the factors is demand pull inflation. What is this? In this type of inflation, actually there is a lot of money supply in the hands of the people. I mean that the people are having a lot of money in their hands, and that becomes that too much of money in few hands, and that increases the price of any goods, and that is also known as expansionist money supply. Government has its own rules to control this inflation by reducing tax or spending more. But in this video, we will understand how RBI or how MPC, Monetary Policy Committee, will control this inflation using this tool that is known as repo rate. So first of all, we have understood that there is an inflation-like condition in which the people of India are having too much of money in their hands. So now let us suppose this is RBI and this is other banks, other commercial banks like SBI, like ICICI or any other banks. So and these are the other bodies like NBFC, state government, central government. So now you have to understand these all are the clients. These all are the clients of RBI. So whenever they will need money, as suppose we are individual and when we need money, we go to these banks like SBI and we take loans. In similar way, these banks go to RBI because RBI is our central bank. So they will go to RBI and ask for money when they have very less deposits in their account. So these are actually short-term loans. These are actually short-term loans given by RBI to these bodies, these clients. Even state government can also have can go to RBI and ask for the money in the form of loan. So RBI will provide loans. But this is not the end. This total agreement is actually a repurchase agreement. What is this called? Repurchase agreement. When I say that when one entity is giving loan to the other client, the other client also have certain responsibility. So they have also to provide something back to RBI. And what they will provide government securities. Government securities is nothing but a piece of a paper which have a value which these banks will provide to RBI when they will go back to return the loan amount. So once they will pay that loan amount, these government securities will be given back to these banks. But as a collateral, these government securities are very much important in this repurchase agreement. So what we have understood that repo rate is a repurchase agreement between central bank, that is RBI, and its clients like other banks, NBFCs, state governments or central governments. When these clients will need certain amount of money in the form of loan, they will approach RBI. RBI will give loan, but RBI will demand some government securities which they will keep as collateral. As this whole agreement is a short term, generally done for 1 day or 7 days or 14 days, like 7 plus 7 days on fortnight basis. So this is a repurchase agreement, but we have understood that this is a repurchase agreement, but how this agreement is helping Indian economy to control the inflation. We have to understand that particular thing by understanding the monetary policy, that how this monetary policy also helps in creation of money and supply of money. So now we will understand how this is happening. Suppose SBI, there is a body, suppose SBI goes to RBI and asks for money. And suppose RBI gives certain amount of money to SBI at the interest rate at suppose 6%. That when SBI have to return that money, suppose 1 lakh, this 1 lakh money will be charged with 6% of interest rate. So now SBI have to return that total amount of money plus 6% interest rate added to that money. So now what will happen is that this will happen for any entities listed here like NBFCs, state governments, central governments or other governments also. So this interest rate will be charged to these clients. Now, we also know that as an individual, we go to these banks for home loans, for education loans, or bike loans, or car loans, or other types of loans. So, we also depend on these commercial banks. We cannot go direct to RBI for bike loan or a car loan like things. So, when we will go to SBI, suppose the car loan is as 10%. SBI is giving 10% on the car loan to an individual. So now when this repo rate was come back to the previous point, when RBI charged SBI 6% repo rate, correct? This was the first case. And SBI charged 10%, suppose 10% card loan to us. Now, if RBI is going to increase the repo rate, you must have heard recently in the news or the newspaper that RBI has raised the repo rate or cut the repo rate by this basis points. Like it was 6%, now they have cut by 500 basis point to 5.5%, like this news. What is this basis points? We don't have to learn in this video, but just for now we have to understand that RBI can increase the repo rate and also decrease the repo rate. So now suppose there is case 1. Now what is the case 1? Let's see here. Suppose the case 1 is like that. Case 1 is like that. The repo rate has been increased from 6% to 8%. Suppose this is a hypothetical example that I am giving, 6% to 8%. So now this SBI will also increase its car loan because now SBI have to return 8% amount back to RBI. Now you are getting the point. Like RBI was giving SBI loan at 6%, but now what they have done, they have increased their interest rate to 8%. So now what will happen, that SBI have to return extra 2% back to RBI. So now they will also they are already charging 10% car loan interest. So now they will increase their car loan interest to balance their balance sheets, like 10 to 12%. They will also increase this. So in an economy, there is always a circular flow of income where whenever RBI will increase the repo rate, these banks will also have to increase their loan interest rate to the individuals and other clients like. So now what will happen when loans will be, now what in this case we have seen that loans will be at higher rate. Loans will be at higher rate. So in this condition, tell me that whether we will go to buy the car or bike at a loan or not. Obviously, we're not going to buy at this scenario because loan will be quite at a higher rate. Loan will be very much different than 10%. So now we have to pay extra amount of the income to get the loan from SBI. So what will happen? This will result at loans will be very low in the economy. There will be very less people who will be going to get a loan from SBI. So what will happen? The money supply that was our precondition in the inflation. Here money supply was high. I already told you, in this demand pull inflation, there is an inflation in which there is always extra money in the hands of the people. So money supply was already high. That was our precondition, just remember. So now if the loans will be not happening in the economy, the loans will be not given to the individuals, this will automatically reduce the money supply. Are you getting the point? This will automatically reduce the money supply because now the people are not getting loans. And why this has happened? Because RBI has increased the repo rate from 6% to 8%. So just to summarize this, our precondition was there that we were having a case of demand pull inflation, in which what was happening that every individual was having a lot of money supply in their hands, lot of money, and due to this there was increase in the price. Suppose everybody have money and there are limited goods in the market. So if all are going to buy car, the car showroom will hike the price of the car because everybody is having good amount of money. So that is called demand pull inflation, when everybody is having a handsome amount of money in their hands. To fight with this demand pull inflation, RBI can increase this repo rate. RBI can increase this repo rate because these all clients like other banks, state government, central government depends on RBI for this short term repurchase agreement. RBI lend the money to these clients and they need the money because if their deposits are less, they will go to the system for having money. And once they increase their repo rate, these are already in the sync. These clients are already in the sync to increase their interest rates for the loan, different kinds of loans, EMIs, and all things. So, suppose there can be also a different case in which RBI can also decrease the repo rate. We have already seen the case of increasing the repo rate. So, it can also decrease. So, now these have to also decrease their interest rate. In that kind of scenario, what will happen that there will be less inflation. That's why that kind of scenario is done just opposite to that. So hopefully you must have understood the concept of repo rate and how it is very much useful, pivotal for uh, fighting with the inflation. So for subscribe for this kind of videos, and this kind of videos will be already available on my channel. Thank you.